Hello, everyone. Today on the final bar, my guest is Matt Tuttle from Tuttle Capital Management. We're going to talk about this overall rotation, growth versus value. It's been the topic we've been debating, discussing, and struggling with over time. You know, what's working today? A little bit of everything. Energy, number one. Technology, number two. Everything essentially in the green, except for a couple of sectors. But the S&P accelerating to the upside into the close, closing above the 4,000 level for the first time. Not a huge surprise on a shortened holiday week, but certainly speaks to the underlying strength in the market. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down these markets together using the power of StockCharts, using data visualization to understand market psychology, investor behavior, trends, momentum, breadth, sentiment, everything we can to try to make sense of the markets in uncertain times. As I mentioned in the introduction, I'm not surprised. I mean, in general, a day like today, which is sort of the last day before a long holiday weekend, anecdotally, it's sort of the senior traders are already off the desk. The junior traders are there to usually push things just a little bit higher, if nothing else. So a bit of a rally into the long weekend makes plenty of sense. For me, the challenge is this comes at the later stages, arguably, or potentially the early stages of a bull market phase. And so seeing this, getting above 4,000 for the first time and closing above it is certainly significant. We're going to look at all the different charts, focus on risk on, risk off, everything we can. Now we have a great guest with us today, Matt Tuttle from Tuttle Capital. Super excited to hear his take on the environment right now. We have the day off tomorrow for the market holiday. Hope everyone has a very happy Easter long weekend. Next week, I will be out of the office we're all out of the office now, but out of the state, taking a vacation to the deep woods of Oregon. No cell phone connection, no internet. I am giddy to unplug for a week. We'll see how easy it is for me to do so, but the final bar will be in good hands. On Monday, we're going to replay one of our recent episodes. I think it's pretty timely, talking about market dynamics. Then after that, we have a different guest host every day. So Aaron Swenlin on Tuesday, Grayson Rose on Wednesday, Julius DeKempener on Thursday, and Greg Schnell on Friday. 4 top analysts. They know their stuff, and I think they will help you wrap each day in a decent style, but also gives you an opportunity to get 4 different takes on the environment. I think you'll be impressed by some of the differences and some of the similarities between each of their discussions. So enjoy that next week. We will be back with you full go on Monday, April 12th. So we're going to wrap the week today. Normally on a Thursday, we just do our normal market update, but today what we're going to do is actually wrap the week, because that's what we usually do on our Friday show. We won't have the opportunity to do that this week, so we'll do it here briefly today and hit on some of the key themes. So as I mentioned, the S&P certainly just pushing higher through the course of the day. The last couple of days, we've accelerated to the downside on the close. Today, we accelerated in the last 30 minutes, pushing a little bit higher. So the S&P closing just below 4020, and again, that's an all-time high. Yet again, a new closing high, new intraday high for the index. Mid caps and small caps even better, pushing to further highs during the course of the day. Small caps leading large, and the NASDAQ leading everything else. So the NASDAQ 100 up 1.8% today. The VIX is at the lowest level since, I would guess, February of last year would be my assumption. That's probably right. We'll look at that chart in a little bit. But the VIX just below 1750 now. Again, it's the bottom had been 20 for the longest time. Just very quickly today, bonds moving higher, yields coming off a little bit. This is why technology and other growthy things do just fine on a day like today, because rates are coming off. Gold and silver moving higher as well. There are very few things that were down today, as you see all the green as we go on. Commodities as a whole up, energy doing just fine with oil prices up a couple percent. And then even cryptocurrencies up. Bitcoin was actually chopping around the zero level and closed around the same. But net, you have positive movements for cryptocurrencies across the board. We're going to look at the wrap the week chart, and then we'll go through the Mindful Investor live chart list to finish the discussion. Very quickly, this is the last week's returns, and I'm going to change this just a touch because we had a shortened holiday week. We're going to start the clock out last Friday, which is the 26th, and then the 4 days since then. Here's what's been happening. The NASDAQ, the best performer out of the bucket of assets that we look at, just in terms of normal asset allocation, the pink line in the top represents the Qs, up 2.7%. In purple, we have small caps up 1.5%. Here's the S&P 500 up 1.2%. Everything else underperformed the S&P this week. In orange, we have emerging markets up 1.1%, which isn't too bad. It's about the same as the S&P for the week. In red, we have bonds up 0.75%, about the same for crude oil. Green, we have the US dollar, just a rounding error above 0.1%, and gold down 0.2% over the week. If we bring Bitcoin in the mix, I usually separate that just to make sense of things, make this a 4-day chart very quickly. And I'm guessing Bitcoin is at the top here. Yep, up about 7% for the course of the week. So again, the S&P up about just over 1%. So again, it's not a huge dramatic accumulation of sorts during the course of the week. This is kind of dribbling higher. But if you look, there are plenty of things moving on both sides, one or the other. You know, it's interesting. I was interviewing David Lundgren earlier today for Behind the Charts. That's our interview style show. We've had some really good conversations, by the way, with Walter Deemer, Helene Meisler, Bruce Fraser, Mark Chaikin, some really fun discussions. We got a number of really good ones we've been recording in the last couple of weeks. I'm excited to share with you. My discussion with David Lundgren, we talk about sort of a stealth bear market, or a market that looks one way if you look at the overall index, but it looks a very different way if you start looking under the hood a little bit. And I think that's what concerns me at the moment, potentially, is you have the market going higher, but is all well under the hood. And this is where you see some questioning signals from things like sentiment or breadth. And we'll look at some of those charts here in a minute. And perhaps you'll see what I mean. Starting with the Mindful Investor Live chart list now to finish off our Wrap the Week segment. As a reminder, you can get to this on your login. Go to the Articles tab, go to my blog, which is called The Mindful Investor. You'll see a gray button right at the top of the page that says Live Chart List, and it'll get you to this point. You're welcome to save it to your own login and tweak the settings, whatever you want to do. The first chart shows you the market trend model. This is a weekly model that I've been updating for years. And essentially, the long-term model has been bullish since last June. That feels about right. The short-term model has been bullish in the last couple of weeks. That feels about right, too. The medium-term model has actually been negative since mid-February. This is when things really chopped around. A lot of pullbacks started to happen, some rotations. That rotational movement that we were talking about really sort of accelerated at that point. It is not quite positive. I was wondering if we'd have enough of a move higher to push this to the positive side. It wasn't. It's almost there. I mean, it's basically right at zero, but not yet turning positive. So I have to say the medium-term model remains negative. So again, overall, when the market's moving to new all-time highs, I've learned over my career not to be too bearish at that time. However, always to be looking for indications of potential weakness, thinking about emergency preparedness, all those sorts of things. So let's look at some of the individual charts and see what we can find. Here's a daily chart of the S&P, and here you can see the new closing high that we've experienced, certainly following through to the upside. Again, my caveat to this is we're in a shortened holiday week. Let's see what happens next week after the Easter holiday and how things progress from there. One of the interesting patterns we've seen is the weakening momentum phenomenon. So as the index has made new highs in January, February, March, the RSI on the S&P 500, the measure of momentum, has actually made lower peaks. And that's a momentum divergence. We've seen that on a lot of the different charts out there. That actually has changed as of today. Today's close actually makes a new high with higher momentum for the first time since back here at the beginning of the year. So indicating that sort of negative divergence is alleviated and indicating that the trend is healthier than it may have appeared earlier. Where we are not seeing a ton of strength, or excuse me, a ton of negativity, a ton of weakness is in the breadth lines, right? If you look at the cumulative advanced decline lines on the major cap tiers, here's the NYSE common stock only first, and then you have the S&P, so large cap, mid cap, small cap advanced decline lines. All of them continue to make new highs and new lows. As always, as a skeptical bull at all times, at best, I'm always looking for signs that suggest that things may not be as ideal as possible. And here's what I'm seeing on this chart right now, which again is not a negative. it's more of a flag that tells me to be watching for price weakness. Is what we've been talking about for the last month. Is, you're seeing indications of potential topping patterns. Look for the breakdowns, which we haven't really had significantly. Here, the S&P advanced decline line has indeed made a new high, but none of the other cumulative advanced decline lines have confirmed this week new high just yet. This is not updated for today's close yet, so we'll see. Given the strength that we saw, do we get these confirming new highs after holding off for much of this week? Remains to be seen. We're seeing an expansion of new highs on the S&P 500 and the New York Stock Exchange. That's good. We're seeing more and more stocks back above their 50-day moving average, over 80% of the S&P. That's up from 50% just a couple of weeks ago. That shows accumulation. I want to fast forward to this chart, which is where we're going to have to stop given the timing of the show. This is the S&P 500 is a weekly chart showing the name exposure index and the RIDEX flows. The name exposure index, and I'm very much generalizing here, money managers and how they're positioned, because it's a survey of money managers and how they're positioned in their equity portion. This has come down in the last couple of weeks, and it's down from over 100% long about 2 months ago to now 50% long, 52%, which is where it's at now. At the same time, the RIDEX flows have actually been increasing a little bit in the last couple of weeks, and overall remain very elevated. Means what this all together implies is money managers taking their foot off the accelerator, individual investors stepping on the gas. And again, when you think about smart money versus dumb money, unfortunately, is what it tends to be known as. Thinking of professionals to amateur investors, what this is telling you is that the smart money is lightening up and getting out of the way, and the retail investors are piling into these new highs. That causes me to just be skeptical about materially higher moves from the current levels. Doesn't tell me that the trend is over yet. The price is what's going to tell us that message. We need to take a quick commercial break. We'll be back with Matt Tuttle. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the market activity using the power of charts, the power of data visualization and technical analysis. As a reminder, we do mailbag segments twice a week. We're going to do one a little later in today's show, and we would love to answer one of your questions in our next mailbag segment in the coming weeks. Shoot us an email with any questions that come up during your own trading, your own analysis. We'll do our best to point you in the right direction. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. On our YouTube channel, just go to the comment section below the video you're watching. Put your question in there. We'll do our best to answer your question in our next mailbag segment. Also, as a reminder, the new StockCharts TV on demand is out and live, and it is really well done. We're super proud of the content, the hosts, the guests, and all the stuff you have access to for free. Go to StockChartsTV.com, use your email to set up a free account, start watching immediately. You can also go to all the app stores, Android, Apple, Roku, wherever it is, StockCharts TV on demand, and you can hit the ground running. I want to welcome on my guest joining us for the first time, Matt Tuttle. Matt's coming up to us from the New York area, is the founder of Tuttle Capital Management. And if you don't know Matt and his work, you certainly know a lot of the ETFs that he and his firm manage. There's a series of trend following ETFs that are out there. Also things like the SPAC ETF, the upcoming FOMO ETF. That's all Matt and his team. So Matt, welcome to the show.
Hey, thanks for having me.
So we've been talking on this show recently just about the overall, rotation. The word rotation, I feel like, has come up a lot, just thinking about growth versus value. A lot of people are struggling now that, things like energy, financials have pulled back. Start us with the value discussion. What are you seeing?
So, I mean, this quarter has been the most interesting quarter I think I've seen. But the most important thing going on is, like you said, the growth versus value. And obviously, we've seen value outperform quite a bit. If you look at it year to date, if you look at it over the past 6 months, over the past 6 months, it's doubled what growth has done. So certainly the vaccine rollout, the reopening, and the fact that value has just been crushed for so long. And at some point, money's got to go back into those stocks. And that's what we've seen recently.
It's interesting how the value ETF, we were looking at the IVE on the screen. I mean, if you just take a step back and look at this last 6 months, it's hard to think of anything. The word constructive just comes to mind. I mean, it's just a slow and steady gainer that's overall continued to push higher.
Yeah, I mean, but what you'll notice if you kind of look at both, day to day now, there's a battle. So today growth won the battle. And, any given day, it's going to typically be a value day or a growth day. And I think, unfortunately, for people who are trying to maybe time this rotation, I think that's just what we're going to see. I think the easy money has already been made in value. And, now, what we're doing with our ETFs is we're tilting. So, we may have a value tilt, but we're going to keep growth in the portfolio. And we do have a value tilt right now. And, at some point we could shift more towards growth, but I can't imagine trying to time this, at this point and say, hey, we're going to be all value or we're going to be all growth.
Right. It's so funny. We love to paint it as an either or, and you're right. There's some nuance there for sure. Chart number 2 that you shared with us, the IWV, it's the Russell 3000 ETF. Again, another, consistent uptrend. What are you seeing overall? We're now at the end of the first quarter. It's been a decent quarter. What are you seeing going forward into the second quarter now?
So, we're seeing, it's an uptrend, but it's not nearly what value was. And, what you saw is such a reversal from last year where, the top performers in, say, the S&P 500 from last year are some of the worst performers this year. I think certainly a lot of those growth names are oversold at this point. And, so today, for example, money went back into a lot of that. So again, what I think you're going to see is that day-to-day battle. And, you can see it in these 2 ETFs. You can also see it, look at the Qs and look at the Dow, but you're going to see that day by day. One day it's going to be a growth day. The next day it's going to be a value day. And, it's just going to be an interesting battle, I think, all quarter.
You mentioned the Qs. We have a minute left, Matt. I brought up a chart of the Qs as you were talking, and a lot of the questions we've gotten have been, certainly there were signals that the growth trade was kind of, reaching an exhaustion point there, January to February. Rising rates pretty much killed the growth trade for at least a little while. When you're looking at something like the Qs that's pulled back, it's broken down through its January low, but all of a sudden starts to revert higher. Does that tell you that it's more of just a choppy period to be looking at, or do you see this more as a tactical pullback within a longer term uptrend, and you're better sticking with the longer term trend with a space like this, looking at the Qs?
Yeah, I don't see any reason why you can doubt the longer term uptrend. Certainly, it went up too far, too fast last year and needed to pull back. But yeah, if you're a long-term investor and you can weather the volatility, I would see no reason to get out of the Qs. And, and at some point, you're going to start to see some outperformance of the Qs versus, the Dow or the S&P. The Qs this year is kind of the ugly stepchild, right, but that stuff tends to reverse. Yeah. And with the Qs, it can reverse pretty quickly. It could reverse in a day or two, the way that stuff moves.
And you're certainly seeing that sort of bounce today going into the long holiday weekend. Matt, listen, I wish we could talk so much longer. I'm hoping we can get you back for a longer conversation down the road, but for now we'll have to leave it there. Listen, wish you the best. Have a great holiday weekend. Best of luck with Tuttle Capital and all you have going on, and we'll talk to you again soon.
All right. Thanks a lot. You too.
That's Matt Tuttle. Matt's the founder of Tuttle Capital Management, and again, provider of a number of ETFs, including SPAC ETF, upcoming FOMO ETF coming very soon, and a series of other things in the works. But I love it when you talk to someone like Matt. Just think about the big picture. The way he phrased it when I asked him about the Qs is, I don't see a reason why you should doubt that long-term uptrend. I'm paraphrasing what Matt said, but I think that's about right. I mean, when you zoom out, a lot of the charts that I'm bringing up as I'm asking the question, I'm thinking, this is a chart that's just consistently going up, and until proven otherwise, I don't know if we've seen enough proof that the trends are over. As always, when I see a market going higher, I look for chinks in the armor. I look for signals that there may be something to worry about. Where I've not seen the worry manifested itself is in prices going significantly lower and breaking the kind of support levels that should make you worry about the long-term trend, the state of the trend. Let's continue on answering your questions from the Final Bar mailbag. Thanks as always for sending your questions in. As a reminder, our email is thefinalbar@stockcharts.com. We're going to be again on vacation for a little while, but keep the questions coming. And as soon as we get back, we'll open the mailbag and answer everything we can. Question number one. This actually just came after yesterday's show. The process you outlined yesterday of using the scooter rankings by industry to assess relative strength is a process I employ as well. I'm summarizing here. Is there a way you have found to pull up all the companies listed in each industry? For example, what are all the companies listed under travel and tourism, which is one of the Dow industry groups that we that we follow? Yeah, so there are two ways that I tend to do it. One is going to the member dashboard, going to charts and tools, going to the industry summary. This is kind of what I was showing you during the special. This has them all listed out, and then if you pick one of the items, it'll list it out. But this gives you everything within our entire equity universe. So there are a lot of smaller names, small micro cap names that might pop in here if they're things that we have in our database. So one easier way you may want to consider is using the scanning engine. And I'll show you an example of one of the scans that I run. If we go here, so scanning engine, you can get to it right from your dashboard. If we look down here, this is a scan I run for high scooter names. I'm going to edit this scan. So what I'm saying here is it's a stock with a minimal volume reading. The scooter ranking is above 90. The market cap's above 10 billion. And group is industrial sector. The last time I ran the screen, I was looking at industrials. I added that last line. If you go down here to sectors and industries, just pick one of these and hit add, and it'll add that phrase. You can just type it literally exactly what it is here. If you click where it says industrial and start typing materials, you will get a selection of other things. So it's looking at the materials sector, the top level sector. It's also looking at building materials, and it's just a keyword search. So all of our sectors, also all of the industry groups are all part of that, just keyword search. So say group is and start typing what you want to look for. So if I would say, like looking for home builders, I can see home construction, home improvement retailers. You pop that in there, you run the scan, and you have a list of stocks just in that industry group. That's a way that I often look for mid cap, large cap names within a particular group that are scoring very highly. I use that exact screen. That's how I would do it. Question number two, summarizing, because this is a longer one. Yeah, the essence of your question is, what does it mean now that the VIX is below 20, is how I would summarize your question. And I had this up. I was looking at this earlier, and yeah. So what you've illustrated is, I think, the strength of the VIX, which is, it's a fear gauge, right? Is the way that we summarize, and it basically is looking at volatility and using that as a proxy for fear. When people get nervous, the markets tend to be more volatile. They tend to be choppier and more violent movements, and that's what causes the VIX to go higher. When we're calmer, we don't tend to be nice and calm and slow and steady during a downtrend. That's more of an uptrend as we're accumulating positions. So if you look at the fourth quarter of 2019, you can see the VIX remains very low as we're just in this slow and steady uptrend, and the market just continues to make new highs and everything's kind of good. The VIX is very, very low. You can see that changes when the market sells off and we all start panicking a little bit. So the interesting thing about the VIX is, overall for the last year, the range has been totally different. Back here in 2019, it remained in a, not really single digits, but kind of 10 to 20, 25 was sort of the range of the VIX. That totally changed. And for most of the last year, 20 has been the floor. 35 to 40 has been the ceiling. The whole range has gone up because it's been a choppier, more volatile period. Now what's happening is the volatility is coming off even more. And so the challenge I have with using the VIX is there's not much of a floor there. And what I mean is, just because the VIX hits 20 doesn't mean it can't go a lot lower than that. It's not like RSI, where the RSI can't go below 0 and can't go below 100 because that's how it's defined. It's a little more fluid, and the ranges will change dramatically year to year, month to month even. So the fact that the VIX is very low basically tells you we're in a period of lower volatility relative to what we've been. We are still at the upper end of the volatility that we have been in the quote unquote normal years. I would say volatility is still elevated relative to some of the historical norms, but certainly we are seeing a lower range. Markets tend to top when the VIX is very low, but I can't say that there's an absolute level when that tends to happen. So at this point, I think it's a monitor and look for the trends, look for signals of price weakness. And I think of the VIX in relation to other sentiment readings I would look at. Next question. At the end of December, all the technicals suggested tech will be the leader of the first quarter of 2021. Then all of a sudden, value and recovery stocks soar while tech got hammered. Now everyone says it's the time to buy the industrial recovery stocks, sell growth and tech stocks. Do you really think this will happen? And this is a great question, given my conversation with Matt Tuttle earlier. People often like to buy at the top and then it changes. As such, does your observation suggest that tech is dead? I love the finality of that question. Is it the end, right? Is tech going to the moon or is it going to zero? That's kind of your question there. So, but you've hit on the same challenge, right? And again, when I was talking with Matt Tuttle, you heard that talking about rotation. We just recorded a special that should be airing very soon on market rotation with Grayson Rose and Julius DeKempener. Basically broke down rotation from a macro perspective, looking at sectors and themes, looking at individual stocks. And, same thing. It's like overall, I don't see horrible negative weakness on the charts of technology names, even things that have had good runs that are coming off in a pretty big way. Like Peloton is probably the example I keep coming back to. The chart of Peloton looks bad only because so many other charts are making new highs still. The chart of Peloton isn't horribly broken though. It still hasn't broken down through its low from November. It still hasn't broken down through its 200-day moving average. It came off an oversold region reading and has bounced up. Okay, it's underperforming because other things are sort of up in the upper end of this. But long term, if you think some of these stocks are going to work, they arguably have pulled back to pretty decent levels. The challenge I'm going to have, I think, with this year is in a rotational year. It's kind of what Matt suggested earlier. It's sort of growth works and value doesn't, and then the next day it's the opposite. Value works and growth doesn't. I would imagine that overall there's upside to be had in all of these places in terms of what works and what doesn't. I would argue the most important chart you could look at is the chart of the 10-year yield, the chart of interest rates, and it's whether or not you think rates go higher from here. If they do, I would say growth charts are going to be challenged, and you're going to have more opportunity in the cyclicals. If you think rates are as high as they're going to be, I think it's a decent time to be getting back into growth. But the point of your answer, I think if you had some value and some growth overall, you're probably going to be doing okay. If you're trying to play that mean reversion game, I think it's going to be a very frustrating and challenging time because I think there's a lot of choppiness to be had. That is our mailbag segment. Thanks everyone for sending in those questions. They were beautifully done. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is what I call my risk on, risk off chart. I have a series of things that we review on this show all the time, and I review with my own clients, and it's summarized in this chart, to be honest with you. It's things like consumer discretionary versus staples, the relative performance of semiconductors, small cap versus large cap, equal weight S&P versus cap weight S&P. The challenge I have right now with the S&P going to new all-time closing highs is none of these other ones are confirming that new high just yet. They may, and it may come later, but at this point, I have the market going higher and other things are not confirming it yet. Chart number 2 is the bond ETF. If you look at the lower lows in the TLT here, February to March, you're seeing the higher lows in the RSI, February to March. That suggests a bit more of an upside bounce, which would be short-term weakness in rates, which certainly would be a tailwind for growth in the short term. We're seeing that materialize on a day like today. Finally, China has bounced off its 200-day moving average using the FXI. Is that sustainable? I'm not sure. What I would certainly be looking for is if that 200-day moving average holds. That's what I'll be looking for here. Ladies and gentlemen, that is our show. That's a wrap for this shortened holiday week. I want to thank Matt Tuttle, from Tuttle Capital Management for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.